Hello, in this video, we'll be going through long-term contract accounting. This is part 4 of a series and the final video. If you have not watched prior videos, I encourage you to do so, especially part 1 and 2, because they will be key in understanding what is happening here. In this video, we'll be going through a long-term contract where there's a revenue being recognized over a period of time for a long project, such as building a building or building part of a freeway, and the company's recognizing revenue using the percentage of completion method means that they recognize a percentage of their revenue every year based on the costs that they have incurred to date. And what happens when the project is estimated to be profitable at the beginning, but then at some point it's estimated to be an overall loss. That's what this video is about. It's about that the entire project at some point becomes a loss. So the accounting for it is different when it comes to the income side of things, or the revenue recognition, I should say. So let's go through. This is the same example we've been using for the first 3 videos. And when I go through this video, I'm assuming that you've already watched those and are familiar with the accounting for a regular percentage of completion revenue recognition when the project is profitable. So 20x, the contract price is $500,000. That does not change for any one of the years. We have this project going over a 3-year period, 20x1 through 20x3. We have the cost incurred during the year, and I've highlighted these in blue because these are the numbers, the amounts that differ from the one where we had an overall profit for the project. We have our estimated cost to complete for each year, and then we have our billings to customers and cash receipts from customers that really only affect the balance sheet side of things, so we're not going to be covering it here in this video. That's covered in the first video. Okay. Let's go through to the accounting for revenue. And year 1 is the same as if we had overall profit. No facts have changed, where our costs to date are $50,000 and our estimated cost to complete is $225,000, giving us a total estimated cost of $375,000. So when we take our cost to date divided by estimated total cost, we get a percentage completion of 40%. And here we see we recognize $200,000 of revenue in 20x1, which is the 40% from the $500,000. And we have our cost of $150,000. So we've recognized $50,000 of gross profit in year 1 and recorded the entries for it accordingly. So let's go to year 2. Our contract's $500,000. Our cost to date is $276,000, and our estimated total cost is $234,000, bringing our total estimated cost for this project to be $510,000. So now our contract price is $500,000. Our estimated cost to complete this project is $510,000, bringing us to an overall loss for the entire project of $10,000. When that happens in accounting, when you're a long-term project at the point in time where it has been determined that the overall project is going to be at an estimated gross loss, then you must book the entire loss that you expect for the project in that year. You're not going to just record the loss for that 1 year, but you're going to record the loss that you anticipate to have for the entire project in the year that you anticipated it. So let's go through the accounting for that for 20x2. 20x2, you still look at the percentage of completion. I'm going to look at my cost to date of $276,000 divided by my estimated total cost of $510,000, and my percent complete is 54.12%. This is still the amount of revenue I will recognize in year 2. So I'm going to take my $500,000 times 54.12%, and that gives me revenue to date of $270,600. Okay, and I have already recognized $200,000 in the prior year. So in 20X2, I will recognize $70,600 of revenue. Now this is where it's going to change for the cost. The cost is going to essentially be a plug because the overall project now is determined to be a $10,000 loss, right? That's right here. In year one, I recorded a $50,000 gross profit. So now to true up from $50,000 gross profit to $10,000 gross loss, I need to have a $60,000 gross loss to record in year two. And if I know that my revenue is $70,600 and my overall gross loss, this should say really loss, needs to be 60,000 to get to a net gross loss of 10,000, then this cost number is essentially a plug to make that work. And I have this calculation right here to show you how to do that. But that's what it is. It's a plug. That's why it says here, see, it says plug. And so now I'm going to record this entry. I'm going to record my, in year two, right here, let's see, year two, I'm going to record, this is revenue for 70, let's just make this a little bit smaller so we all fit into the screen. In year two, I'm going to record a credit to revenue from long-term contract for $70,600, which comes from right here. And I'm going to debit cost of construction for $130,600, which is my plug. And then the difference is going to be the gross loss that I'm going to record in the current period of $60,000. So now if you look at my year one plus year two revenue, I've recorded 270, if you look at the sum down here in Excel, I've recorded $270,600 of revenue. I've also recorded $280,600 of costs, which nets out to a $10,000 loss. Okay, so that's what happens that's what happened in year two. I record the entire loss for the project needs to net out in year two. Now let's go to year three. Year three, the contract's still the same, $500,000, and right here. And now my cost today, my total cost for this project ended up being $520,000. And so now when I look at my gross profit, or I should say gross loss, I have $500,000 of revenue and $520,000 of cost, which gives me an overall loss. This is the end of the project, a $20,000 gross loss. So let's go see how we record that for year three. Year three, I recognize up to that point, now I'm done with my project, I should recognize my full $500,000 of revenue. I have recognized already, I've already recorded $270,600 between year one and two for revenue. So I should, let me just move this note real quick, just so that arrow is not in the way. I should record revenues for $229,400 in 20X3. Now, the overall project loss is $20,000, okay? And in year three, we really don't need to do we don't need to do a plug because we have our total costs right here, $520,000, right? That's to date. So we have an overall loss on this project of $20,000. That's what it actually came out to. And so now when I go here into the second column for the amounts that are recognized in prior years, I have recorded $150,000 of costs in year one. I recorded $130,600 of costs in year two. So the total of that is $280,600 of losses that I've already recorded. So in the current year, the last year of this project, I'm going to, my total cost is $520,000. I've already recorded $280,600. So my remaining cost to record is $239,400, which gives me a gross profit loss for 20X3 only of $10,000. Now I want to show you, if you take, so once we record all that and we go look at all our revenues and costs, we'll have recorded $50,000 of gross profit in year 1, $60,000 of gross loss in year 2, and $10,000 of gross loss in year 3. And when I add all those numbers together, let's see, here, you can see here that the sum of that, the sum of all those numbers, my pen is not working. It's being pretty finicky. But the sum is right here on the bottom is a $20,000 loss, which is exactly what it should be, because this $20,000 loss is what we've incurred for the entire project. Okay, so let's go and record year 3. Year 3, we should have revenue of $229,400, a credit. Our costs for the project, costs for construction, is a debit for $239,400, and then we have a credit to, which is a plug, to construction in progress for $10,000. Now I'm going to go down to our T accounts that, let me just move that note. But the T accounts is for the construction in progress, we record a debt, we debit all the costs that we incur during each of those years, and that is covered in the part 1 of the series of videos covering the balance sheet entries. And then we have $50,000 of gross profit in year 1, $60,000 of gross loss, and $10,000 of gross loss in year 3. But at the end, and then we also recorded our billings for each year, which means our accounts receivable billings on this account called Billings on Construction Contract, which is a contra asset account to the construction in progress. Let's go to the end. The subtotal at the end of 12/31/X3, the end of the contract, I have a $500,000 balance in CIP and a $500,000 credit balance in the billings account. And I need to close that out. And so what I'm going to do is I'm going to end up debiting billings on construction contract for $500,000 and crediting construction in progress for $500,000. And that's this very last entry right here that we do at the end of the contract. And again, I think we've gone through this before. The balance sheet has to show your accounts receivables, but it also has to show the net amount between the construction in progress and billings on construction contract. If your CIP is greater than your billings, that net amount is recorded as a current asset. If your billings is greater than your CIP, then that net amount ends up being recorded in current liabilities. So when you have, I'm going to reiterate, when you have an overall loss on a long-term contract in the year where that is anticipated, when it's decided that, yes, we think we're going to have overall loss on that project, the amount that you have to record in that year you have to factor in the gross profits you've already recorded in prior years, and then what the amount you're going to record in that current year, in 20X2 in this example, is whatever it takes to make it so that overall you have a gross loss between all the years for $10,000, or the gross loss equal to the entire project. And the way you do that is you book that through the cost of construction account, and it's a plug, okay? So this is using the percentage of completion. Now let's go into the completed contract method. So usually when you're using the completed contract method, you're going to record all your revenue and all your costs in the last year of the contract. But that is only applicable if the overall contract is profitable. So let's go through our same set of example, 20X1, we anticipated a gross profit of $125,000, so we wouldn't do anything under the completed contract method. Now 20X2, now we're anticipating an estimated gross loss of $10,000. Even though we're not at the end of our contract, under the principle of conservatism for accounting purposes, we are going to record this entire $10,000 loss in year 2, even though it's a completed contract method. And the way we do that is we're going to debit our cost of construction for $10,000 and credit construction in progress balance sheet account. Notice this revenue from long-term, we're still not recognizing the revenue until the end of the contract. So we don't recognize any sort of revenue in year 2, but we do recognize this loss. Okay, now let's go to year 3, the end of the contract. Contract price is $500,000. Our total cost that we actually incurred was $520,000. And so now for the overall project, we have a $20,000 loss. So let's see how we're going to record that in year 3. So year 3 is when we actually recognize the revenue from the project. So we're going to credit revenue from long-term contract for $500,000. And for this project, if you look at the overall cost for year 3, it's $520,000. We've already recognized $10,000 of cost in year 2 for that. And so to recognize a total of $520,000, we're going to record $510,000 of cost from construction year 3. So then when I add up the year 2 plus the year 3 cost of construction, it equals $520,000. So now I've overall for this project booked $520,000 of costs and $500,000 of revenue, which gives me an overall loss of the $20,000, which is what it should be. And then to make this balance sheet, this journal entry balance for year 3, I have to credit my construction in progress account. Let's go down to our T accounts. So in our billings on construction is just our accounts receivable billings that we've had throughout the term of the project. That has not changed. In our construction in progress, every year where we have our construction costs, we debit our construction in progress account, our CIP. And here you can see the $10,000 loss that we've recorded in 20X2. It should say gross loss, not gross profit. And then we credited the CIP account another $10,000 in year 3. Now at the end of 12/31/X3, we have a total debit balance of $500,000 in the CIP account right here. And then we have a total credit balance in the billings account for $500,000. And we need to close that account out at the end of the contract by reversing those those balances. So we're going to debit billings for $500,000 and credit construction in progress for $500,000. And that's going to be this very last entry here on 20X3 to close those out. Again, balance sheet presentation in 20X1, we have our accounts receivable, and we have CIP in excess of billings of $30,000. In year 2, we had our billings was greater than the CIP, and the net of that is $54,000. So we have a current liability. So you just need to be, I think it's always a good idea to lay out the T accounts for those two balance sheet accounts, the CIP and the billings account, because that's what's going to determine what you're going to report on your balance sheet. And also at the end of the contract, they should have mirror amounts. Whatever is a debit amount in CIP, assuming it's a debit, you should have the opposite amount in your billings. If these two amounts, before you close them out, are different, then there is going to be some sort of mistake in one of your journal entries that you have booked, depending on the example you're using.